Once again, we're just, Mona, seeing more and more navigation necessary by big tech companies of geopolitics. Is that an overhang for you?
Yeah, thanks, Caroline. It's a great question. Look, I think as we get closer and closer to election time period, we will be hearing more and more about the policies that both sides of the aisle will be proposing. And a lot of times what we see is the impact is felt in an outside way in certain sectors. And technology is certainly one of them. I'd point to healthcare as another, depending on regulation and policy that's administered. Higher taxes, as was noted earlier, higher tariffs, taxes in general, does tend to be inflationary. So we have to think about that. Will the administration want to take that step? Or is this more symbolic in nature in that we don't want to, one, enter a more meaningful trade war with China, but two, we want to signal to them that they cannot be flooding the market, whether it's EVs or any other end market or good that they may be trying to get into the U.S. So keep in mind, some of it is signaling, some of it has real meaningful implications for areas like technology, but we will get more and more insight into how these policies may unfold, I think, as we get closer to the November time period. I'd say more broadly, we are looking at a market that has been driven still by the momentum behind AI and technology and mega cap technology in particular, but we do expect that to broaden over time.
And can that broadening withstand still issues? You mentioned inflationary pressure coming from tariffs. Inflationary pressure is still something that the Fed is still very focused on. We're hearing from many a Fed member at the moment saying we're going to be higher for longer. We see stocks just take a little bit of a dip on the back of that context, Mona. Are you expecting inflationary headwinds to limit some of the increase in the stock markets from here?
You know, actually, we are in the Jerome Powell camp, who he did outline, you know, he had the famous line, he doesn't see the stag and he doesn't see the inflation. We are also of the mindset that we do think inflation can gradually, perhaps not in a straight line, but gradually move more meaningfully towards that 2% target for a couple of reasons. One, we do see that shelter and rent component playing some catch up. We are seeing the data in real time. If you look at a Zillow rent index, move meaningfully lower. That has not yet showed up in any of the CPI baskets. And even the PCE basket, which is a lower part, has a lower exposure to shelter and rent, still hasn't moved meaningfully lower. So we think that's coming. Number two, we are starting to see more meaningful potential slowdown in the wage gains component of the labor market. So labor market, a couple of early signals of softening. Not only the non-farm jobs report on Friday, but also the jobless claims figure this week was elevated. We think over time there'll be better balance in the labor force, more supply coming in, less demand for jobs, which will lead to softer wage gains, which has a direct implication on services inflation. So the combination of shelter and rent and a softening labor market, we think, will lead to better inflationary trends going forward. That combined with this earnings growth picture that we are seeing continuing to outperform and improve meaningfully, we think is a good tailwind for equities broadly.
Interestingly, here in San Francisco, the one key thing that comes up time and time again is how expensive engineers are, whether it's particularly in the field of AI. Software developers a little bit less, but still they're arguably about $1 million in terms of their overall pay at the moment, Mona. I'm interested in what you make therefore of AI, the tailwinds of AI more broadly. Are we going to see, when you mentioned the broadening out, which industry groups in particular, is it the healthcare industry groups that we start to pile into?
Yeah, you know, it's a great point, because thus far what we've seen is most of the gains from the AI trade have been felt by the enablers of AI, the infrastructure players, semiconductors, for example. We do think over time you will see the sectors that will benefit from the productivity gains of AI start to place a meaningful catch up as well. And you mentioned healthcare, that's certainly one of the sectors. But if you look at financial services, if you look at manufacturing and industrials, all of those sectors we think will be beneficiaries. And this is over, you know, not a 12-month period, but probably more like a 3 to 5 year period. We will start to see those productivity gains come through. And keep in mind, those sectors are not only prevalent here in the US, but globally, when you think about where, you know, manufacturing, financials, industrials tend to lie, it does tend to be in non-US markets as well. So we think there is a case to be made to have exposure to the US. We like having exposure to that mega cap technology, but also the sectors that may benefit from AI, but also international, we think still plays a meaningful part of your portfolio.